Across the Atlantic Ocean lies a subtropical oasis that beams of exotic beauty. With its signature pink sand, aqua water, and classic rum swizzle, Bermuda is the gem of the Atlantic. Journey today with the Reinsurance podcast as we head to this island paradise to take part in Bermuda's annual Risk Summit.
Hello, everyone, and welcome to another episode of the Reinsurance podcast here in Bermuda. I'm your co-host, Jared Lee.
And I'm Ben Rose, and we're here at the Bermuda Risk Summit with Carlos Wong. Welcome, Carlos. You run global reinsurance for AM Best, so we're going to get as much insight as possible from you as we can in the next 10 minutes.
Thanks for the
or so.
opportunity, yes.
So obviously there's a ton of reinsurance people here out in the rain at the moment. What's everyone talking about at the moment as you go around the conference?
Well, what I think is there is a consensus view at the moment that after a few years of de-risking of balance sheets, changes in underwriting policies, finally, companies have produced very good results in 2023. They've produced stellar ROEs, but still, when we talk about attraction of new capital, startups, as we had seen in previous hard markets, that's not happening. Capital is hesitant. And what we believe at AM Best is that the cycle here is a bit different. Whereas in the past, the cycle was triggered by a significant event, erosion of capital, and this need for new capital to try to respond to very sharp increase in rates. In this case, we have seen a much more prolonged period. So abundance of capital, low interest rates, and since 2017, Harvey, Irma, Maria, actually a very gradual process of readjustment of rates and terms and conditions. And actually, what we saw is that underwriting results improved significantly since 2021, but 22, we saw the impact of the high interest rates, unrealized investment losses on the fixed income portfolios, and that depressed ROEs significantly. 2023 has been a bit different. So very good results, but it's still first year after several bad ones. We think that after the changes that we have seen, still expect good results in the next couple of years, probably not as good as these ones, but we are positive. However, there are still a number of uncertainties, concerns about casualty books, where we have seen some reserve strengthening, new risks, and yes, so companies have retrenched a bit. There's a challenge more long-term about how to recapture that business that companies are trying to avoid these days.
Makes complete sense. And I wanted to go back to one of the first things you said, which was that we didn't have this class of 22, 23 emerge. Do you think there's a chance of that changing if the industry continues to post good results? Like, was that the window to do it immediately after the big adjustment, or?
I would probably have to wait for a bit longer. There are two things. One is the cost of capital has increased as well. So there is a higher risk premium these days. There's a perception of more uncertainties in this market. The second one is that if in the past it was possible for a relatively small to medium-sized reinsurer to get into, let's say, a property cat line, now I believe that it's a bit more difficult. One of the things that we are saying is there is actually no such thing as a shortage of capital as such. It's actually companies remain very well capitalized. It hasn't been like in previous cycles where capital was eroded, but companies are much more cautious on how they deploy that capital. And the ones which are very well established, which have a very diversified business profile, are in the best position. So having small, medium-sized disruptors is much more challenging. And this is because on the primary side, there is a certain flight to quality.
Yeah.
Say there's still strong demand. Companies are retaining more than what they used to, and they are trying. But at the same time, it's not just that they are looking for better credit quality, for good financial strength. They are also looking for um, reinsurance support, which is well diversified, which can provide them with a whole package.
Yeah. Yeah.
Yeah.
One of the things we saw last year with in 2022 renewals was the sort of perceived lack of retro capacity for the
Yeah.
reinsurers. And we saw the retro come back a little bit. How are you sort of seeing the relationship between available retro capacity and how reinsurers can use that as capital? Is that something they're using less? Have they calibrated away from that, or is that still quite central to how
There,
reinsurers capitalize?
there is definitely a strong relationship there, and I would say it's not just a retro; it's the traditional market and the ILS markets as well. So all this issue about expansion in capital that we saw until 2017, 18, and later say available capital plateauing, we have seen it both on the traditional side on the ILS side. Between 2013 and 18, ILS capital almost doubled. And from then on, it remained very, so okay, there has been some sharp increases last year on the cat bond side, but that has been offset by reductions on the other ILS classes. Now, you mentioned about retro. Something interesting is that these days, even when we speak to the large reinsurance capacity providers, their appetite for property cat, to a certain extent, is conditioned to that retro availability on the ILS side. Yeah. So what we see is that if in the past the role of ILS used to be seen as a direct competitor of the traditional side, and even as the main responsible for the soft market, these days they are seen as partners. See, when you look at the large reinsurers, everybody has got an ILS platform or a partner who they share risks with, and their decisions on which balance sheet or which type of capital is supporting particular types of risk. So yes, we see there's more capacity on the retro side, but those attachment points still remain at very high levels, so it's remote capacity. And so on the primary side, we see the pressures, they are very visible. So companies which have to retain more have to absorb that volatility and adjust their own pricing and underwriting guidelines as well.
Yeah, that's something I was actually wanting to tap your brain on a bit. So we're seeing this shift almost from companies which for a long time on the primary side were able to hand quite a lot of their sort of peak exposure over to the reinsurance market, suddenly handed a lot of that responsibility back.
Yeah.
How do you think different primary carriers are coping with that new responsibility?
With lots of difficulty.
Yeah.
And I would say, yeah, some, I would say probably some of the more concentrated small ones are going through an existential dilemma. So there's lots of pressure. They definitely have to rethink about how to manage that business, because what I would say is for a long period of time, we could argue that the balance of interests wasn't particularly aligned, and companies on the primary side were able to make profits to a certain extent at the expense of the reinsurance market, which was awash with capital. Well, these days the situation has changed. Yes, and we don't see reinsurers actually getting back to those higher frequency layers. It has been the hard market is being characterized not just because of the higher rates, but because of the tightening of terms and conditions. And I doubt that will change anytime soon.
Yeah.
And that's mainly because of the reasons I explained before, the fact that the main trigger is not the lack of capital, it's actually underperformance.
Yep.
And it's been the first year, so we should expect that to take a bit longer to rebalance that appetite that we saw in the past.
Yeah. Well, and that's what we've sort of heard from the market as well is it's not a lack of capital, but the capital is being more selective. And the role that we're seeing data playing where reinsurers are demanding a lot more evidence on a portfolio from their
Yeah.
cedents. And if the cedents can't sort of provide that evidence or provide that clarity of the underlying portfolio, the reinsurers are saying, well, we just can't offer you as much capacity as we
Yeah.
give it. Like they have it, but they're being a bit more scrupulous around how much they're willing to give away and under what conditions. So it's tightening of terms and similar. And I think from what we've heard in the market is as cedents begin to prepare better, cleaner, more structured data that they have better command of, that they then pass on to the reinsurers, that will begin to sort of unlock that capital that's there. But you're seeing that relationship between how reinsurers are thinking about protecting their balance sheets and now that they're getting some good performance for the first time in a number of years, being quite protective of that, as they should be. They want to go, how do we maintain this level of performance over the next
Yeah.
few years and sort of get that balancing of the market conditions?
That is correct. If you think about initiatives to raise capital in the last few years, we have seen a number of projects, uh, but with good sound business plans. But first of all, they are probably smaller than some people would prefer. Second, they haven't been able to raise additional capital for these ventures. And even if they were to, I don't think that they would have a significant impact in the market as a whole. At the same time, we've had some well-established reinsurers, Bermuda-based ones, which have been able to raise significant amounts of capital to deploy in a selective basis. And you have the big Europeans, which have maintained very active policies of actually returning capital to policyholders, to shareholders. Yeah, so very active special dividend and share buyback programs, which they feel under more pressure to keep these days because of the higher interest rates, because there is a higher cost of opportunity in respect of other investments. So we look at that as something likely to continue. Now, your point about data, the way companies become more selective to underwrite and to price risks, I think that that's critical because until now, mainly the strategy has been to retrench from areas which are considered too volatile, too difficult to price, being very, very cautious about emerging risks as well. Yeah. But the big question is, what is the role of the industry as part of the broader economy? Yeah. So those risks are likely to increase. Yeah. So the industry needs to reassess. And I think that that's probably the main area where innovation offers an opportunity. So how to price that, how to engineer products that actually can absorb these risks that companies so far are trying to avoid.
Yeah, I agree. And would you say, as we talk about newer risks or areas where the market is perhaps shying away at the moment, are we facing a different peril set to what we had historically? Like wildfire
Not
seems to come up a lot more, and SCS and so on. Are they
there.
new or?
Okay. On the one hand, there are risks which have always been
Yeah.
there. They have become more frequent.
Yeah.
They have become more significant, and in that respect, obviously, wordings have tightened. Yeah. So the modeling that type of perils is still at an early stage. So that needs to develop a bit more to make investors feel more comfortable about how to absorb those risks. So that's one hand. The other one is the emerging side, which is say all the new technologies which are emerging, but at the same time all the transitional risks that are associated to adaptation to climate change. Yeah, so we see there significant opportunities, but still the market is at a very early stage about how to model, how to price those risks,
Yeah.
and develop products which are capable of take those risks under their balance sheets.
Yeah. Well, in an environment of like ever evolving exposures and perils, if you will, how does a rating agency think about the reinsurer's exposure to things like climate, things like cyber that maybe weren't on your radar maybe 5, 10 years
Mhm.
ago? Like, how are you looking at evaluating those sorts of components to a in an already complicated sort of business framework?
Well, we have, say, first of all, there are extensive discussions to try to understand how companies see their own risks. And it's very, very important to try to understand how companies assess their views of risk, and as opposed to simply taking their views from CAD modelers, yeah, which can be something different. So that information, say, more and more, I think that a bespoke view of risk is important to make the difference. Yeah, when companies actually feel comfortable taking those risks. And the other thing is, at a practical level, say, apart from that, what we see as well is how much we can stress companies' balance sheets. Yeah, so how they manage their exposures in terms of limits and concentration. And some of those stress tests can be quite severe as well. So it's a discussion between what the company thinking of and our view based on what we discuss across the industry.
And do you think that those stress tests will continue to change as the world evolves? Are we
Oh,
all-
they definitely continue to change. Yeah, and say we don't have a crystal ball, yeah, but say we try to apply significant margins there, and but particularly trying to understand how companies see them and how they are able to manage. So it's not just reducing the analysis to a number and stress test, as you know. Say our analysis of balance sheet or big car is only one of the components. Obviously, it's an important component, but the fact that a company passes that test doesn't mean that it necessarily translates into a positive view of the rating.
Yeah, no, it makes sense. And then at this event, the Bermuda Risk Summit we're here for, what is the primary objective you're trying to get out of it? Is it just working alongside clients of yours and companies that you rate, or are you working with other capital providers? What is the
For
primary
us,
mission
it's
for
an
you?
opportunity to share views, to see how the market is evolving, to obviously say we meet here with a number of rated companies. Say tomorrow we're participating in this panel with other rating agencies. We have meetings with regulators as well. I think that it is interesting to see how different stakeholders of the industry collaborate with each other. And that's a word that has been used quite a bit in the
That's good.
sessions
Yeah.
today and yesterday,
Yeah.
collaboration. Definitely, say, you have from the say authorities here to brokers, carriers, investors. From our point of view, what we see is definitely there is discussion about jurisdictions in general, regulatory environments. Yes, we don't favor anyone in particular. Yes, we have our views about counter risk. All that is public, and we see all the positives and negatives as well. So definitely, on the one hand, we see Bermuda as a very well established domicile, yeah, where there is good infrastructure, good regulatory regime. There are some issues about costs, yeah, about changes in tax regime, yeah, but say all that is something that we assess as part of our counter risk tiers. And say so far, what we see is probably there is a bit of a different view between companies which have been established here for a long period of time and those which are thinking about setting up something new, yeah, and may start considering other options. But say that's something that is not necessarily a critical part of the rating process. Say it's good always to understand what's the reasoning behind that, but we don't favor any jurisdiction in particular.
Yeah. And perhaps one final question to get your view on, obviously, it's old news almost, but ever evolving. What do you think of the AI and how it's being talked about or possibly used amongst the industry? Does that affect your view of the industry's chances of success in the longer term, or where things might go, even for a rating agency? Will rating agencies start embracing an AI future?
Yes, well, we have to be careful. We have serious restrictions on how we use AI, and it's not that we ignore the fact that it is an important development, but we think that it will. So, if the question is that if AI is going to replace rating agencies, I doubt that that will happen anytime soon. From our point of view, the process actually is not changing dramatically. What we need to bear in mind is how it affects companies in terms of both on their own operations and on the risks that they cover. Yeah, so that is part of the discussion that we have.
Oh, wonderful. It's been such an interesting conversation. We really appreciate you taking some time to speak with us on the Reinsurance
No,
Podcast.
thanks for the opportunity.
Thanks, Carlos.
Thanks,
Thank you.
Carlos.